across Africa. The firm itself has been around for over 20 years. So initially focused on Europe and Israel, but now our focus is on Africa. The whole team is focused on investing in tech companies on the continent. We invest across all stages, so from seed to Series B in terms of the first check that we write into a company, and then are able to also follow on. Minimum check size we'll do is $500,000, and we can invest as much as 10 to 12 million over the life of an investment for investments that are performing well. We're sector agnostic, really looking for tech-enabled businesses, so companies that are solving a critical challenge on the continent and that are using technology as an engine for growth and scale. I've been with Telecom for 8 years now, so I joined back in 2013 to raise our Africa fund. So it took us quite some time to raise our fund, because back then, you can imagine 2013, when you say Africa, VC and investing in an investor room for our fundraising, the room got empty very quickly because the people understood Africa didn't understand tech VC. The people understood tech VC didn't understand Africa. So finding the person or the investor who kind of fit in the middle took us some time. But our first fund is $71 million that we've been investing out of. And some of our investments in Kenya, I'm assuming that the people on the call are in Kenya or work in Kenya. But anyway, so our Kenyan investments, we invested in Twiga Foods, which is in the agriculture supply chain. We're invested in Pula, which is in insurance, which is actually quite opportune, because I understand that the entrepreneurs on the call are in the insurance space. We also have investments in Nigeria, in logistics, education, business services, marketing, and the like. So fairly, sector agnostic. You're on mute, Tonya.
There we go. Good. So kind of just jumping into it. So I was reflecting earlier, and I think, I know we've been saying this for a number of years, that Africa is at a tipping point, but I really think that our time has come, right? There's super wired across the continent, including some of the recent announcements that we've seen with Facebook and so on, or Meta, forgive me if I'm saying the wrong company name here, but, with the investments in terms of wiring and continuously wiring up the continent. I think, early days, we had a huge talent issue, but we're seeing a lot of fresh talent in the market, particularly in the tech space. So I remember seeing a statistic that says we have something like 700,000 developers on the continent at last count, and I don't think that includes the entire universe of developers. I think that, there's a pro-innovator kind of stuff going on right now. So, for example, the Africa Continental Free Trade Agreement that really opens up the African market, because I think for anybody who assumes a single country market, unless maybe the extreme would be Nigeria, but anyone assuming a single country market in Africa is really just limiting their potential. So I think that there's a number of things that are coming together and are really exciting. And I think that there's a huge untapped opportunity, particularly in the insurtech space, right? So when we look at the fintech space, we've seen what's happening in the banking sector, and there's a lot of innovation happening in that space. We're now very involved in really kind of encouraging and building up the insurtech sector. So opportunity is huge. And I think that everybody on this call is at the right place at the right time. I was curious to know from your perspective, Andriata, what's exciting you right now on the continent, even in general terms, like what's the buzz you're feeling? And could you share some of that with us?
Sure. I think, so for me, I think the thing that excites me, and I guess linked to why I do what I do, is the innovation that you're talking about that's happening on the continent. And it's the entrepreneurs that are on this call, right? Because without entrepreneurs, we don't have a business model, fundamentally. So we need people like you who are the risk takers, going out there and, identifying challenges and trying to solve those challenges. So that excites me, because I think, just speaking as an African, I think there are many problems to solve. Our citizens and our residents deserve more. It's not going to all come from the government, and it's not all going to come from NGOs. There's a significant role for the private sector. So if you're looking at the economies, it's not the governments that are necessarily driving the economies, it's the private sector and it's the entrepreneurs. So for me, that excites me, and I think the potential is unlimited, and technology is very exciting because it allows that acceleration, right? If you think about what does technology do for us, I think also I'm preaching to the choir when I'm talking about technology, because technology fundamentally increases access, it reduces cost to serve, it increases efficiency, it helps you gather data to make better decisions and get more insight, which really allows you to be able to grow and scale your business faster than you would have been able to do, say the 1990s, for example. So that excites me, and the fact that the entrepreneurs are young and have a lot of energy, and this is the future.
Fantastic. Good. So looking back, what was your first investment, your very first investment, and what really struck you about them? Why did you make that investment?
Sure. So at TLCom, I guess our first investment was Andela, actually. That was the first investment that we made. And what struck me about Andela, and maybe I can speak more broadly around how we think about investments, and that could be useful also for the entrepreneur, so that it's not specific to a company, but kind of the general way that we assess investments.
That's great.
So we're trying to ask ourselves 3 buckets of questions, right? So the first question is around the market. So is this an attractive market? So we're looking for large, growing, underserved markets with good unit economics, with where you can fundamentally scale. And for us also, because we're coming in as an investor, we also ask ourselves the question around how do I exit this investment? Because our funds are 10 years. The most you can extend is like maybe up to 12 years. So it is actually long-term capital if you think about it. 10 years is a long time. So when people talk about patient capital, venture capital is very patient as well. It's not just impact capital that's patient. But we also think about, okay, who could buy one of these and what's the value that's being created? So from a market perspective. And then we are also trying to answer questions around the company itself. So the company in terms of, okay, so this is an attractive market, but is this a business model? Is this a strategy that can capture this market? And is this a team that can execute on this business strategy? And then in relation to that, we look at other players in the market. So what makes them stand out, and what's their competitive advantage into the long term? What makes us think that they can win? And so that's the second bucket of questions around the company. And then the third bucket of questions around the investment. So is this a good investment for us? Because fundamentally we're investors. We've made a promise to our investors as well. The investors in our fund, where they have a return expectation. So we're investing, we're looking at when the return expectation. So part of that is around the entry valuation, the attractiveness of the market when you're thinking about exit. We're minority investors, so we don't take majority stake in your company, but we do ask for minority protection rights. For us, we take board seats. We like to be active with our portfolio companies to support them fundamentally, because we find that many are first-time founders. So they're very good. They're probably very good and knowledgeable about their space, but we have the advantage of having seen many of these, right? Because we run a portfolio of several companies. So if it's questions around strategy, expanding to different markets. So like us, we have offices here in Nairobi, in Lagos, and in London, and we also have very senior partners. So we can also bring our networks to bear to support the company as well. So if you can check those 3 boxes, then we would invest. We're not always right. It's a venture model, so we do come in at knowing. So when we invest, we want to make sure this is a potential 10 to 20x return expectation, depending on the stage. But we know that a third of these probably will not return capital. So there's a risk element to it, but going in, we need to have a conviction that this is a company that can actually grow and scale.
A short follow-on question.
Sorry, go ahead.
How do you weigh those three different buckets? Is that in order of priority, or is it kind of like equal weight across the three categories?
So the first one, if the answer to the first one, if it's not a large growing market, then it's a no. Then the other ones are irrelevant, because you can have a fantastic entrepreneur, fantastic business, but if after everything is said and done, they get up to, say, $3 million in revenue, which is legal, legitimate, and good, but it's not good enough for a VC investor, then we would never move forward. So I would say that kind of the market is the first one. So many companies fall on that market. So it could be, everything could be great, but if it could never scale, then we would never go in. So that would be the first one, and then the company is also fundamentally important, because especially at seed stage, right? You're really investing in the entrepreneurs. Maybe at Series B, there's a bit more flesh around the bone, but you need to make sure that this is a strong team. So assess that this is the strong team, that the business model could work and that they can win in the market. And then the valuation. Sometimes, there's sometimes where it's a great market, but the valuation is too high, so would never return equity. So it would never be able to return like significant capital. So then we don't invest because of that. So it could be a great market, great company, but just a terrible investment for us. Maybe for earlier stage investment, but for us. So it's So I guess an investment can fall on any of these three, but I would say like market fundamentally is the biggest filter, and many companies fall on that.
Okay. So you talked about valuation, and I have to say, this is not an area that I am an expert in at all. In fact, I think half the time for startups and ventures, you kind of get the sense that for VCs, they see so many deals. And so you have a really refined sense of how the market is valuing deals. And then here we are as the startup coming in, and it's almost like being in a car yard without knowing the model of the car and how much the price is for the car. So I've come across different pieces of advice. It's like some people will say it's best to get a small valuation, or it's like this is always a bit of a tug of war. What advice would you give the people on this call in terms of like maybe top 2-3 things they need to think about in the context of valuation?
It's a very good question, and it's a difficult question because it's very subjective, right? Because especially with earlier stage companies where there's no EBITDA to multiply, there's no assets to think about. So fundamentally, what we're looking at is trying to get a sense of kind of how big can this become in the long term. Because when you're able to actually bring numbers to your thoughts around valuation is, a couple of years out, you now have some revenue, then you can compare with what's happening in that space globally. And then we think about what's our return expectation today. So it's a very interesting, it's a difficult, I guess, conversation because it's hard to tell. But I mean, most of the times it's really about kind of the multiples within the markets that you serve. So that's usually a good indicator. I think also the other thing is the fact that when many times entrepreneurs try to optimize for valuation, but in practice, at the end of the day, what you should be more interested in is a bigger pie, right? So if you're going to raise, say, at a lower valuation, you raise less money and then you grow incrementally, versus if you say there's another investor with a maybe slightly lower valuation, but they're able to bring, more value addition, bring in more capital, then that to me, I think would be a more valuable investor to take, because it's not about, because you can have 100% of a $10 million company, or you can have 10% of a $1 billion company, right? So I think sometimes it's good not to be so short-sighted by the number today, because value is only extracted at exit anyway. It's not the paper money that we see from round to round as well. So I think when you're optimizing, it's not just about kind of valuation, but look at the other benefits as well.
Okay, great feedback. So I see Maurice has joined us, masquerading as Dan Aseda. In fact, I was like, I'm not sure who that is. And then I saw your face and recognized you. So it's great to have you here with us. I saw you nodding away. I think that maybe you have something to add to Andreatta's commentary there. But I'm going to ask that before you add, quick intro of yourself so that the team on the call actually get to understand who you are. Tell us a little bit about what you do, tell us a bit about Baraza, and then, add some commentary to Andreatta's comments.
Thank you so much. I don't know if you guys can hear me clearly.
Loud and clear.
Yeah, I've had a lot of technical challenges, so I had to quickly commandeer one of my colleagues' laptop to use it. That's why, for today's purposes, I'm done. So my name is Maurice Otieno. I'm Executive Director at Baraza Media Lab. At Baraza Media Lab, basically, we're an incubator for media startups who are focusing on new, interesting models of how to storytell and looking at sustainability. So basically, we deal with very, very early stage kind of entities who are maybe at MVP stage, trying to look at their viability as a business. But I think for the context of this conversation, there's also my other hat, which I wear as a board member now. I used to run Meta Nairobi, which was basically an entrepreneur space based out of Riverside, connecting investors to startups and startups to investors likewise. I think I was nodding because some of the conversations around valuations, I remember we convened a very interesting curated group, and Andreatta was actually one of them. And at that time, there was a lot of, for lack of a better word, murmurs in the investor scene around how startups are being valued at a very high point, maybe inhibiting a couple of investors who are active in the market to be able to come in. So we convened this conversation to basically understand why. And what Andreatta has repeated today is exactly what she said on that day, and what I've heard consistently in terms of, as much as valuations is interesting and it's important, it's also an art. So it varies from one player to another on how you can say this is my value, especially in a market like Kenya where again there's not enough data sets from your capital markets authority or competitors to know what value or this startup is or my company is. So but however, as much as that is not something that you have to just sweep under the rug and say I'll not concentrate on it, there's also the options and the rights that investors are coming in, because those are the key things in terms of the future of your organization and the relationship you have with the investors once they come in. The valuation is one thing, but how do you interact with them post investments is critical. For example, voting rights, and Andreatta has also indicated they sit on the board. So what other support can this investor bring on board with this investment that will enable me to grow, not only now, but even in the future? So that's why I was nodding, because I was completely agreeing with most of the points that she was mentioning. And sorry again, I'm late because of technical issues.
No worries at all. And it's great to have you, and good insights there. I know we're going to spend a bit of time, Andreatta will drop off at 6, but we'll spend a bit of time kind of digging into your current hat around storytelling and how some of that can play a strong influencing role in terms of how then you pitch and engage with potential investors. So we'll talk a little bit about that as we go along. So coming back to you, Andreatta. So we talked about market, and I think you kind of explained that really well. And then we talked valuation and investment worthiness and the ability to return on that investment. I wanted to dig a little bit deeper on the team concept, on the founding team or the founders piece, right? And I think it's a well-known fact that everybody will say that, the first, you're investing in the team, right? Especially if it's an early stage investment. What do you look for in a founding team? You're going to have a couple of meetings. Like I said, you've gone through hundreds of these. You probably have a wonderful system that allows you to identify what makes a great team that you would invest in. Any tips you can share with the audience on that?
Sure. So with the team and the founders, I think a couple of things. So the first one would be around kind of the understanding of the market that they're serving, right? So that's quite key because you need the networks, you need to understand if you're in automotive and you've never done automotive before and you just came up with it, you probably won't be as strong of a founder. For example, maybe you can build it over time, but at least so the experience of the founder and the founding team as well. Maybe if you don't have it, then industry knowledge, perhaps at least your other team members must have something significant within that space. So I think the experience. The experience is key. I think passion about the space is key because being a founder is hard, and I'm sure everybody on the call can relate. And I think the thing that really keeps you going is just your obsession on how to solve this problem. And this should come through, right? There was a podcast I was listening to, and the person was talking about why do people want to be founders and like reasons not to be a founder. So one was like, I want to make a lot of money. So the guy had done some regression analysis and said, in fact, if you had been maybe the head of product at Facebook, you'd have made more money than being a founder or the head of, I don't know, something at Microsoft or wherever, right? So it can't be just the money that's motivating you. It has to be something more, and that something more is an obsession that there's this problem and I need to solve this problem, and that should come through because I think that's what really keeps you as an entrepreneur going, right? Otherwise then you'd give up. So I think that's another piece. I think also there's another piece around, especially when we look at founder, we also look at who's around them. So who have they been able to attract to come around them? Because it means you can sell the vision and you can never execute on it by yourself. So does this founder have an ability to attract really strong C-level and middle management to work with them and come on board? So that's also key. So it can't be a one woman or a one man show because then that's super risky. You need to have an ability to also attract strong people around yourself. I think so those are, I guess, kind of the key ones that come to mind. I think also the point around kind of who's around them, because I think part of being a founder is also about partnerships and influencing. So to get investors on board, they need to buy into your vision. To get partners on board, they need to buy into the vision. So that ability to communicate that vision, I think, is quite key. We're looking for people with integrity, people who are consistent. Many times we follow entrepreneurs for a couple of months before we invest. So there just needs to be like consistency within the story.
Okay. I like that. Maurice, do you want to add anything to that?
Not as of now. I think she mentioned one thing earlier on, but I wanted to just double down on that in terms of if, let's say, you're a tech platform and none of your founders has any technical capabilities, then that is a problem and a red flag, because then it means you'll be dependent on that resource, and it's a key resource that holds your business up. So that is also very important. Or if you are for example, in insurance and let's say none of your founders has expertise nor knowledge of the industry, then it becomes a bit challenging. So that subject matter, at least within the founding team, is usually very, very important to just be able to anchor you in that sector that you are in.
Yeah, I think that, and that's more common than you can imagine. I know, like it happens more often than not. Okay, so I'm going to ask one more question and then I'll open for Q&A, primarily because we know Andrietta will be leaving us, and then we'll continue thereafter. Kind of as a roundup, and actually I have two questions for you and I don't know whether to ask them. Maybe I go with them both at the same time and you can answer them both, then we open up for Q&A. The first is, what is the one thing that you would advise every founder to think of before walking into a meeting with a potential investor? What's that thing that is almost the thing that helps create the magical moment for you? What do you want them to think of and have top of mind? That's my first question. And the second one is more personal, which is to ask whether you personally make any angel investments, and is your criteria the same as your company's criteria?
Sure. Thanks for the question. So I think in terms of how to prepare yourself for an engagement with an investor, for a meeting with an investor, I think the first thing that the main thing I think is to know your business fundamentally. So the things I was highlighting in terms of kind of the market, competitors, how you're different, because I think that's easy for you as a founder to do, because this is what you do on a daily basis. So be an expert at your business and have some of these answers because they're going to ask you anyway. So I think when somebody to me comes across as knowledgeable about the space that they're operating in, that gives me confidence, because investors, we never run your business. You're the one, we're giving you the resources to run your business. So I need to have confidence that you as an entrepreneur have interest enough to learn these things, and then also are keen to have kind of this type of knowledge around your business. Know your numbers. That's also something that's really key around like, don't be scared of numbers. Like, take the time, be comfortable in the numbers, because investors ask questions around numbers, because fundamentally, this needs to be commercially viable. The story is important, but I can only be carried away the story for so long until now you show me the numbers and I'm like, what? So then the story gets you in the door, but then the numbers and knowing your market, that keeps me listening and keeps me attentive. And then I think it's also important to know the investor as well, because investors are very different. So take the time to do research on the investors. Because some are impact, some focus on particular sectors, particular markets. Some are tech, some are not. So it's important to get to know the investor. Then you also, when you go in, you're targeting the right type of investor for your business. And then, because fundraising is exhausting, and I say this because I also fundraise. So when you know that this person is a likely fit, then your chances of success are much higher. And then it's also not, you're not spending as much time talking to many investors as well. Is another thing that I would say. I think also the other thing to keep in mind, this is maybe not for a meeting with your investor, but just generally, is that fundraising is it's a very emotionally taxing activity, right? So when you do it, I think it's important to, like, as a founder, to make sure that your team, it takes a lot of time. So make sure that it's actually, one, you have other people that are taking care of the business as you're fundraising, because you will have many conversations. And two, to own it, because I think many founders think of it as a complete waste of their time. Like, they wish they could just give them the money, they go and run the business. But you need to own that this is part of your job description, because if you need capital to grow, that makes it part of your job description. Otherwise, you can't scale your business without the capital. So actually embrace it as one of the things that you do. Maybe not the best thing not one of the most exciting things that you do, but you need to put in that energy. It's almost like when I think about fundraising, sometimes it's like when you're putting on a show, because it's like you need to bring the same amount of energy. If you meet TLCom, then you go and meet Partech, then you go and meet Novastar, because your energy can't be dwindling, because this investor is seeing you for the first time. So also just to make sure, like, mentally, like, you're prepared for the journey that it is. And again, I empathize because I also raise capital. So I'm not speaking this very theoretically. Like, it's also fairly real as part of my job description. Now, in terms of whether or not I do angel investing, so unfortunately I can't do angel investing because I can get a conflict, right? Unless maybe I go and invest in, I don't know, something that's not tech enabled, which most things can be tech enabled. So we're not, just for conflict of interest, we're not actively investing. I'm invested in our fund. So my investing comes through that channel. Because you know what, sometimes what some of the conflict, you may be wondering what kind of conflict can come up. So say, for example, I'm an early investor in company X, and then company X is scaling. Now TLCom is now assessing the company. How is it? I'm conflicted because I'm an investor in the company, so I want them to raise capital. But am I making the right decision as a partner at TLCom versus as a shareholder of this company? So you see, you end up with these conflicts that arise. So unfortunately, I can't. But it's really more through TLCom that I'm doing my investing. And if I was to do it if I could invest as an angel investor, I would definitely use the same criteria as well, because yeah, that's how you can only get kind of the companies that would scale. Maybe one last point. I think also for entrepreneurs, it's also important to know that like a validation. If an investor says no, it doesn't necessarily mean that your business is not a good business. It means it's not a good fit for them, or they can't see it, right? So it's also important. So you also need to, pick yourself up and keep.
Did we lose her, or is it just me?
I think we did.
Okay.
Yeah, but as she's just coming back online, there's one point that she mentioned about talking to Novastar, talking to Partech and all. I think there's also a key thing that I've seen over time within entrepreneurs pitching either to investors that I know or that I've introduced them to, which was as you come with the same energy across board. If you, let's say you you fault on something with one particular investor, it's also a very small community. Where you almost have to keep that reputation going. If you are known as a founder or as an organization for a particular kind of behavior to one investor, then just be wary, because it might be across board, knowing that you are this type of person. So also that image as an organization, or the way you pitch or the way you present your business, or let's say today you pitch to Andriata with this concept, tomorrow you pitch to Novastar with a different idea, the next day you pitch to Partech with a different idea, then it just breeds that lack of commitment to solving a particular problem, which might not sit well with most investors. So you want to keep that brand value across board. I think Andriata is back. Sorry, I took over your conversation.
No, thanks very much. Sorry, my connection failed. I don't know what's happening in Nairobi today. But I completely agree with Morris, because also investors talk to each other, right? And especially in VC, we syndicate deals. So it's not that, like, very often I'm co-investing with other investors. So they're calling me, asking for an opinion, and vice versa. But anyway, the point that I was trying to round up earlier is the fact that to also remain motivated. I think if an investor says no, it's important to ask why they said no. But also now, if you still believe in your vision and in what you're doing, to keep going and to keep asking, because I mean, to keep fundraising, because different people are caught by different ideas. It could be, there are many reasons why an investor can say no. So to still also remain, it's disappointing, but you need to keep going still.
Very good.
And investors can be wrong.
Yeah.
Tonya, just before we let go of Andriata, I just wanted to have a follow-up with you, Andriata, on that question. So more than often, I've seen people who ask for feedback or get feedback from the investor, and go change it. And they go talk to another investor, get feedback, which is good. They're doing basically what feedback should be done. But then don't you think when they keep on going and getting that feedback and changing it, then by the time they're going back to investor one, the product is completely different? And what does that speak to you as an investor when you see an entrepreneur who's, yes, doing what feedback should be done with, implementing it, but kind of sometimes veers them off to just focus on what investors want instead of what the market wants? How would you pick that?
Yeah, it's a very good question. Can you hear me well?
Yeah, we can.
Okay, it's a very good question, and I think here the feedback that you of course as an entrepreneur you need to assess the feedback, right? Like you need to go back and think about what's my business, what's my vision, does this make sense? So it's not that you're collecting all this feedback and then you're implementing it. It's particular sets of feedback, especially if something is consistently being mentioned by everyone that you're speaking to. Then you need to look a little bit closer, right? So, for example, I think feedback around maybe, for example, your team. Maybe they come back and say, you know, nobody in your team, for example, has e-commerce platform. You're an e-commerce platform. You should probably get somebody in e-commerce. That you should take. If an investor is maybe telling you something about your product, then I would question that a little bit more, right? Because you're the one closest to the customer. If it's maybe something around perhaps strategy and how you're thinking about expansion, that's something to think about a bit more deeply. So I think it depends what it is. And of course, don't take every feedback, but I think it's important to assess it and test it out. But certainly not to, I think you should, some entrepreneurs don't listen at all. You don't want to be that entrepreneur. Some people, entrepreneurs take everything. You don't want to be that entrepreneur. So it's like the balance is somewhere in the middle.
Very good. So we've got a couple of questions for you, Andreatta. The first one from Kingsley is, do you find that the investment thesis of VCs on the continent are such that it makes foreign investors more attractive for African founders? I presume as opposed to local VCs being attractive for local founders.
Yeah, I'm not sure what you mean by investment thesis, but what I will say though is that so the difference between what maybe I can speak some of the difference between the local VCs, and this is speaking generally. I can speak more confidently about ourselves, and then kind of foreign VCs. So I think the benefit that local VCs have is the kind of on the ground ability to help and to support entrepreneurs, and I think that's very valuable for entrepreneurs, especially like, our Nigerian entrepreneurs are moving to Kenya. They're tapping me to be able to support, to make introductions, to, give them insights about the market. If somebody is sitting in Silicon Valley, they have no clue. You can't call them for that, right? Maybe you call them for something else, but definitely not for that. So I think the local presence, local knowledge, insight, that's an advantage that local VCs have. And in fact, what I've seen is that many foreign investors like to see a local VC because they can help you with that piece. And also it's a bit of it's a validation, right? That, okay, somebody locally actually thinks this is a problem. So I think a good balance is probably having a mix of these, because I think sometimes if you're overly weighted on just foreign investors, you miss out on, one, they don't understand your market really well, so they can't really help or support you, which I think is a disadvantage in the long term. So you might be happy when you get the cash, but the cash will run out. And then the next time you're back in market, you need to be able to show that you've shown traction. I think what's happening right now, though, the market is completely out of whack. There's too much capital floating in this world right now, whether it's from the US printing cash, all these IPOs that have happened. So there's just like so much cash around. So there's been a lot of money being thrown around. So the market is completely mad, if you ask me. So I think foreign investors, especially US investors, they come in with very high valuations because that's what they're paying in their markets, right? So that's where sometimes there's some competition with local VCs who understand the nuances. Like, yeah, this is maybe a fintech company, or this is a SaaS company, but the scale that you can get in the US is much faster than what the friction that you see in this market. So and it's true because they understand the market a bit more. So I think where maybe entrepreneurs feel that foreign investors are better is because they're giving them high valuations, because they're early, these are rounding errors for many of them. Like they wouldn't care if they lost $2 million, right? I care because my fund is $71 million. So that's real money. So I would put the effort also to support you because it's real money in that respect. So I mean, I think this goes back to the, I guess, point around valuation and value add that an investor brings. So to really weigh that properly, because also I think while you can get a high valuation now, when you go back to market in 2 to 3 years, you need to have met those milestones because you're getting, say you're a seed company, you get a Series A valuation. When you go back to market, you're now at you now need to show you've met those milestones and you can meet, say, the Series B kind of milestones. And if you can't do that, then you have a down round, very painful thing to do.
Okay, good insights. Let me go to the next question. The next question is from Brian. He asks, when going for a seed round, what's the average amount of time a founder should expect from first conversation to potentially being able to close the round?
It differs, hey. It differs on the right now. If you're a fintech company, you could be in market for 2 minutes.
Yeah.
But in normal times, I think realistically, like I think founders should give themselves 2 to 6 months. When you're maybe even longer, maybe 3 to 9 months. It depends on your business. It depends on where you are, kind of the type of traction you have, the network that you have also plays a part. So anywhere from 3 to 6 to 9 months, I think, is reasonable. Also because there's actually a process. So there's the point at which from the point I, as an investor, I'm like, oh, this is really interesting. I actually also have to do work, right? So I can maybe talk about the process there. So we need to do business due diligence, which for us can take anywhere, say, 2 to 4 weeks. So here we're talking to the team, we're talking to your clients, we're talking to your partners, we're talking to your investors. So everyone within your ecosystem. So that can take anywhere to better understand the business. So that can take anywhere 2 to 4 weeks, right? And then if that works, then we issue a term sheet. Then there's a time for negotiating the term sheet, right? So that can go really quickly, or it can take a lot of time if there's, some issues that need to be ironed out. So let's say, for example, you're able to manage to do that in 1 to 2 weeks. And then after that, then what we do is we go into financial, legal, and tax due diligence, which we wouldn't do as the investor. We get lawyers and tax consultants to do that due diligence. So that takes you another, say, 4 to 5 weeks just to do that. And here for us as investors, we want to make sure, the company is who it says is the company, the financials are what they say they are, because people have invested in something and realize it doesn't even exist, right? So you need to check those things. What are the liabilities, those kind of things. So it's very standard for any decent investor. And I'm not talking here like an angel give you $10,000. This is somebody bringing a couple of millions of dollars. So even just between our business due diligence up all the way up to close, at the same time, you're also doing the documentation. That process can take 3 months, maybe 2 to 3 months. And this is after the person has conviction that they want to invest. So just from that standpoint, 3 to 9 months, I think, is a reasonable time to give yourself.
Okay. Good. Next question. Are there cases where the investor prematurely exits the startup? And if yes, what is the main cause for this premature exit? Is this common?
I guess it depends how you define premature exit, because so for us, we exit at the time. So I guess there are 2 things that are driving exit, right? So the first thing is that the company has reached a stage where we feel like, it's extracted significant value. We can get a good return from this investment. So that's one way we think about kind of when do we exit. So if there's still value to be extracted, then we would stick around for a little bit longer. So that's one thing, just looking at kind of where's the company, is there value to be created. Then the second piece is around the timing. I think I mentioned in the beginning that your typical funds are 10 years and you could probably extend for another 2 years. So depending on when the investment was made. So maybe if the investment was made in year 4 or 5 of the fund, that means the fund has only another 5 to 6 years. So then they would look to exit after, say, 5 to 6 years. So which is still a long time, huh? In the grand scheme of life.
It is.
Yeah. So I think those are kind of the two keys that we think about when we're thinking about exiting. But sometimes, investors can exit sooner for different reasons. Maybe they run out of cash into cash problems. Maybe not as a fund, but if you're an individual, and then you need your cash out to do, I don't know, pay for your children's education or whatever. But I think your typical fund, we want to wait it out, at least to extract the most value from it. I hope that answers the question. I don't know if you have it sounds like you may have like a specific example.
Wema, does that answer your question?
Yeah, it does. My prematurely, I meant like if maybe you had said 10 years and then something happens and you're like, this is not a good investment, we should leave now. So is that common, or whenever something happens, you always try and stick around and solve it?
Okay, I guess I guess I wouldn't call that premature as much as it is like you're assessing the situation, right? Of because this, like the example you gave, it's a company that's not performing well. So maybe the best thing to do is to sell the technology, or latch them to another company and extract that value, because even if you waited, there's still no value. Like you could stick around for another 2 years, but then the company is still not doing well. So it's not necessarily premature. I wouldn't call that premature, but it's more that you're given the environment, probably this was the best time to think about exit. Also, when we come in, we don't commit to a certain number of years, right? In terms of when we would think about exit. But in reality, we look to, at least as we look to be in 7+ years to really see growth in some of these companies.
Good. So we've got two last questions for you, and I'll start with the first. I think the second question I'll direct to both Morris and yourself, because I'd love to hear your views on this. So the first question is, at what stage do you start cleaning your cap table, and how does that work in terms of ROI?
So when you say cleaning your table, I guess like selling to earlier investors. So it's not necessarily, usually what happens is you have a round, and then there's more interest than the capital that's available. So then those people want to invest, say, okay, let me go and buy the early investors, because in this fresh capital, there's no space for me, but I still want to invest in the company. So it's not necessarily a strategy for me as an investor that at point B, I'll start cleaning up the cap table. It's more around kind of available capital, or if I want to, like if Telkom wants, say, to have more ownership of the company, then we can think about that. So we don't really. So it happens. Usually, it's around funding rounds, where you have an opportunity for the early investors to exit.
Okay. So the second one is to both of you, and it's really our wrap-up one for you, Andriata. What are your views on some of the huge raises we're seeing? So Wave at 1.7 billion, valuation on Series A, Chipper Cash at 2 billion. Even for me, it's like just this fantastical, maybe, amazing stuff happening on the continent. Would love to hear both your views on that.
Did I mention that the market is crazy right now?
I think it just makes investing in fintech harder for Andriata, because now everybody will be coming with crazy valuations. But in terms of liquidity, I don't know how the investment worked, but maybe it makes more money available from a local. So somebody was saying like Paystacks exit might have made 200 people $1 million. years. That was just something that he was talking about, and saying how that money comes back to the ecosystem in terms of angel investing and all. So I think it, from the valuation standpoint, I think it only hurts mostly the investors, right? In terms of now most startups will start, especially in the fintech space, will make the market become very expensive for the investors, especially local investors. But then from a liquidity perspective, I think it helps the ecosystem as a whole to have more angels who exit, maybe if these guys were cleaning up, and it helps them exit and have more money in the community. That's my perspective. I don't know what you think.
Sure. So I think it's good from a liquidity standpoint because we need more capital in the ecosystem. In fact, some of our portfolio companies have benefited from this craziness as well. What I will say, though, is that I think at some point this will end. So while it's good to be able to, get this cash, grow and scale your business, it's also important to not lose sight of the fact that you still need to meet your KPIs, and you still need to grow, and you still need to show traction, because then at the next round, when sanity has returned, like, you need to show up with a company that's actually like that $2 billion, right? And if you're not able to do that, then the company then the company could go bankrupt, or you won't be able to raise additional capital, or you do it at a very low valuation. So I think it's a moment in a long life cycle of a company, and it's good that more liquidity is coming. But I think the companies that are getting these high valuations just need to make sure that they hit their KPIs, so that they're not caught left-footed when the rug is pulled under all of our feet, right? But this is not just a Kenyan phenomenon; it's globally, like in the US, in Israel, in Europe, in China.
Is it a bubble?
Perhaps, but who knows when it will pop, right? But right now, you can ride the wave. I think you can benefit. Just keep your wits about you, and also because sometimes too much money can distract founders. Hey, then you're just spending on things that don't matter. You lose focus and lose sight. But I think if you're able to use the resources well, it's fantastic.
Okay, so I don't know if you have one more minute for one absolute last one. And I believe this is, from Joel. So what would a founder-friendly term sheet look like from your experience? So he says he's seen some terms such as non-dilution and drag-alongs, etc. And long time, they really look scary.
What does I mean, I think those are like some standard, what do you call this? Standard terms in term sheet, but you just need to, what I would say honestly is get a lawyer to help you. Don't try to negotiate the term sheet yourself. Get a lawyer to help and to support you and read, so that you really understand what these mean in the long term. But I actually have to dash. I'm actually a few minutes late for my next call.
Thank you
thanks
so
everyone.
much.
Okay,
Thank
great.
you so
Take
much,
care.
Henrietta. It was great having you. And have a great evening. Huh?
Thank you. Thank you very much. Bye.
Good. So, Morris, you're holding court now. I would love to hear just on that last question, because you've got tons of experience in terms of founders, investors, and kind of creating some level of serendipity between those two. In your view, from a founder-friendly perspective, what's your take?
I think I'll go back to what Henrietta had mentioned earlier about the conditions in terms of not even the valuations, but terms like what you've said. I think it's Brian or talking about non-dilution and exiting options, and so those are the simple lines that most people who are just founders do not have that context of how does it affect me now, or how does it affect me when I'm going for a second round of investments. And this early on investor does not want to dilute their shares. That means I have to either give up more and all. So I think I'll stick to what Henrietta said. Like, find a professional who is a lawyer, if possible, to just go through that process with you to understand that. Because the term sheets is not even about the amount or the shares that they are coming in or with, or it's about those details in terms of how they'll be running or governing, helping you govern the organization, because that is what has ended up a lot of founders being kicked out or not understanding some of the terms. So I will highly suggest that leave it to the professionals who are the lawyers to just help go through that process when you get to that process of investments.
Good advice.
Yeah.
Good. So let's switch gears a little bit. We've talked with Andriata, and it's really been on the money, hard and like kind of very concrete around what do you need to do, how do you get ready, how investment decisions made. I want to switch gears a little bit into preparing the founder themselves, right? To be able to drive the right level of engagement with a potential investor. And I know you're well known actually across the continent for your network, but B, also your community building skills, right? And I was wondering, from a founder's perspective for you, Maurice, how important is that networking component, right? I mean, I know we read a lot of stories coming out of Silicon Valley, so I kind of cold email investors. Is that the model for our market? And what do you recommend a founder should do?
So I'll speak from experience of what I've seen other people who have significantly or successfully fundraised do, not abroad, but here in Kenya. So one of my friends, Daniel Yu, the founder of Soccer Watch, was talking about he was never a people's person, front-facing, so very shy. But he said, for his own words, as a founder, I almost became like the face of the organization. I became almost like the walking billboard of the organization. Because again, people start putting trust to the face and the name of the person who they trust either to provide this good as a client. For investors, provide to steer this company to profitability for them to have successful exits. Also to a team, trust them that they'll trust this person, that this person will keep the company alive for them to continuously have a salary. So networking is almost inevitable. I know most people some people are usually very introverted, or not even introverted, but do not like being in the public domain. Unfortunately, in this case, to some extent, you have to be in that space where people are seeing you, people are talking to you, and there are various ways how I've seen most people do it. So I used to run Meta, where we used to have over 30 events a month. That's almost an event a day, and I would see how much founders would be jostling to find a spot on that stage to speak about a particular topic that they are in. And in that case, it was not a matter of just I'm speaking, I'm famous, but for them, they're using that opportunity as a way of getting themselves known to even either an investor who's here or a cousin to an investor who's here within the audience. But also at some point when they had raised money and they needed to grow their team, they're also using that opportunity as a way of attracting good talent. So that public appearance is not just public appearance for the sake of that and making you famous. It's an appearance with a mission. You're almost working with that target in terms of, I want to either know this number of people who can either be employees or can be investors of the company and all. And also, as Andriata had mentioned earlier, it's more relational, it's more emotions. So you find when you are interacting with the people on a public stage, in a public gathering, then they also kind of see how you as a person relate. And does that add value to them as an organization or as an investor?
So your take and your advice would be get out there, find the right forums. Yeah.
I'll highly recommend be more. I know it's a lot. It's tiring for founders to be able to do this. I mean, in my capacity in both organizations, Baraza and Meta, I've been forced to do that. Luckily, I'm more extroverted and I feed off people's energy, so I like networking, but I have to be in those spaces. Likewise to any founder who's out there, I think finding those spaces, finding those WhatsApp groups where people go and have their own dinners and all is where you should be, so that you kind of market your business, even to founders who might not even be interested to fund you. Because I believe that those are the guys who actually give you unfiltered feedback about your business with no strings attached.
That's fantastic. That's a great point. Okay. So let's talk a little bit about the power of storytelling. And I know that this is one of your pet topics, right? Do you just want to give a bit of an intro as to the context of storytelling and why this is important to founders?
Yeah. So storytelling is almost an easier way of you selling everything about your business, from your awesome team to your going concern as a business, to the impact that you want to create. What I've noticed is that there are some people who use, I'll use this term, most early stage startups use very interesting and affordable ways of storytelling. Because again, storytelling in itself, as a business, you can imagine you have very limited resources, and dedicating your resources to this not guaranteed returns, in terms of storytelling, is sometimes not the priority. But here it's why it's a priority. Like, if you utilize that, you attract the right talent. If you utilize that better storytelling element, you attract the right partnerships, the right investors, the right even markets, right, or even partnership opportunities. So I found out that most people utilize platforms like LinkedIn for storytelling, and storytelling depends on what platform you're using. If you're pitching up on a stage, I've seen a lot of templates coming out of all over the world in terms of start with the team, end with the product, or really emphasize on your valuations. But I think it's about the connections that you want to put across. If you're pitching to investors, then probably they care less about your impact if they are commercial investors, but they care more about your returns, right? So it's just figuring out who am I telling the story to and tweaking that story to fit that particular subject. If it's on a panel and your main idea there is just to go and get more talent, then you speak about how awesome your business is. I think you cannot have one pitch deck for all these customer segments or people that you as a founder are talking to, in terms of you almost have to tweak it based on who you're talking to. And even if you dig deep into, like, it's only investors this is a pitch for investors, you also have to tweak it for what kind of investors. If it's impact investors, how do I tweak it to understand the impact that I'm creating? If it's commercial investors, how do I focus more on the returns, the strategy, the total addressable market and all? So it cannot be static. It has to be dynamic, but there has to be sort of like a flow around it. Yeah.
So to take you one step deeper, and of course, these are startups, and the context of this conversation today is engaging investors, right? So speaking of storytelling in the context of engaging investors, what for you are then the elements of a great story?
So there has to be a why. Why, for example, am I in this business? Why am I the best person, or why is this the best team to solve this problem? And that speaks to what Andrietta was talking about, the team and the technical know-how. So why am I the best? And why are we solving this? Why is this problem so urgent for us to solve it now? Then, of course, you have to talk about the how. How are you solving it? And how are you different from the other people who are solving this problem? Then last, I think there should be an element of your ask. What do you need from the investors? Because again, they have other things to do. You do have other things to do. So why am I here? What am I asking for? The ask also is very important within that process. So if you bucket those things, you can broaden the why to talk about the problem itself. You can broaden the why to talk about the team, because this is why this is the best team. You can broaden the why to talk about the urgency of the solution of the problem you're solving for. For example, if you are in insurance and you're seeing how there's a lot of fundraising being done on social media and how destructive it is, and how it's bringing down a lot of generational wealth that are being created, So that's the why, within the why. Then within the what you're doing to solve this is now the technical, the product itself. And within that, you can also, to take you back to the why, I think you can also have the total addressable market part of your presentation and the storytelling to just explain to them, like, this is why this is very humongous from a business opportunity also. And the how, of course, we have to talk about the tech. Yeah, I think that's how I'll cover it. There are some formulas that people use, but it's almost like the Simon Sinek, common Simon Sinek word of start with why. So it's why.
Yeah, that's actually what I wrote on my notes. Yeah.
Exactly. So it's always start with why, what, how. And that's why I've seen most pitch decks starting with, in terms of storytelling or even pitches, where people start with the problem, right? They have not even introduced themselves. They start with this, the problem. There are so many people who are facing hunger in Kenya, and these the numbers according to this WHO, I don't know, or FAO report. And my name is Maurice Otieno. So basically, when you're going back to Maurice Otieno, it's almost you're validating, like, why am I the best person to solve for this problem? And in there, you see people throwing in basically name dropping, like, oh, I have a degree in this from Harvard, and that's why I'm the best person for this, So there's so many storytelling angles that I've seen people use to catch the attention of people, especially if you're doing either your pitches or you're having an investor like, let's say, Andreata for like 10 minutes, and you really want to tell her the why. Why is this? Why should she give you additional 5 minutes? And then you add the product later. The problem is that I've often heard most people say that some people go first of all with the solution, and then by the time you're done, they don't know what problem you're solving or what is the opportunity, especially if it's a commercial investor. So maybe you start with the opportunity or the why, then you go to the solution. This is why we are solving this.
I like that. And I really like particularly the start with why concept, because it really does provide the right anchoring for the narrative to then ensue thereafter.
Yeah.
So we've talked about a couple of things. We've talked about storytelling. We've talked about the importance of networking. I see a question in the window, and it leads to kind of what my next question was about, which is, I was having a conversation actually with one of the startups in this cohort, and it's almost like, so where do we find these investors, right? I'm here, I'm busting my ass, I'm building a business. I don't know where to find these big money, high-powered people and have the right conversation with them. Where would you advise people to find them? So I know you mentioned the Meta example. I don't know if they still do it. It would be fantastic if they do. Can you give some of those tips around, these are 3 areas where you find access or that are access creating environments?
Yeah. Actually, the funny thing is that most investors do not even want to publicly say that they're investing because of the barrage of, let's say,
correct,
emails and everything. The trick that I've found most people use is, let's say, for example, you are all founders on the call. You do know of this founder who has fundraised. And what I've seen with most founders in Kenya is that they are very patient with other founders who reach out to say, hey, I would like to just take you out for coffee and learn how you did this, maybe in agri or healthcare. And with that, you make a rapport with this particular maybe startup founder who got investment from these other investors. And so it's almost like you get in one leg and you eventually move in completely, So you get one friend who's an investor who probably introduces you to another friend who's an investor, or probably hangs out with other investors because that's what they do. So you get an Andreata today. Probably Andreata over the weekend will hang out with Patek, Novastar, and all these guys and invite you along. But especially if you go in, and I think that's the thing that I've seen, especially with the challenge with, and I don't want to politicize this event, but the challenge with, let's say, foreign, local funding, all that conversation is because there's that patience of me as, let's say, Brian, who has asked the question, to have that leeway to have multiple coffees, multiple events, because again, I'm not hustling right now to pay my rent right now. So I create that relationship with these founders. So I'll go to their events. I'll meet one, for example, and there are so many ways you can meet, either LinkedIn, which sometimes they'll not reply. Or you meet Tonya, who knows Andreata, who Andreata introduces you to Niraj of Novastar, Niraj introduces you to Wale of IFC, so you get to know all these guys, and you start hanging around with them with no intention, because it's almost like when I see an insurance person or any person who's coming to talk about bank accounts, I run away because I know they're trying to sell me something. Mm-hmm. So that's the same idea, sort of like analogy I'll pick. If you are a startup and you're going to meet this investor for coffee for the first time, their expectation is maybe that you're going to just ask for money and all that. You could ask to know about the organization better so that you can better maybe pitch next time, or ask for feedback without any expectation from them to invest in your company. And in that, maybe it gives them confidence to introduce you to other investors who might actually be interested in your business, or introduce you to other investors with confidence that you will not go pitching, So there's that period of patience that you need to just build that network. And it could be get in through one person, then get to know multiple of them. And I've also seen platforms like there's some Ido. I'll remind me, I can share the link with you guys later. There's some Ido of I think it's Telecom. Actually, they have done a very good job to map out.
I think it is Telecom. Yeah,
yes, it's Telecom. Yeah. They have done a very good job of mapping out all these investors across Africa and their contacts. So emails or sometimes even phones. And these, I've seen some people utilize that kind of platform, not to pitch for funding, but just to give you updates. So either quarterly emails to all these guys, telling them your progress and what you're working on, without any expectation of returns. So I've seen a couple of people do that over time.
Okay. All right. So I'm going to ask you two questions I asked Andreata to get your view. I know Brian has a question pending in there around in-person networking events. I'll ask that when I come to the open Q&A. First question to you is, what single piece of advice would you give every founder on this call, particularly in the context of the conversation today around engaging investors?
Wow. I will highly recommend when you're going through the fundraising journey. It's almost like a tiered approach to how you finally become very familiar with most of them. And the tiered approach is, first of all, clean house, set your house in order as much as you can, right? Mm-hmm. Then if you do find an opportunity, let's say, to know this one investor or this group of investors, go in with no expectation of something being given to you, but just first of all get to know them as investors and as people, right? Then once you've done that and you get a lot of feedback from them about your business, then, because remember what Andreata said, they start monitoring you way back. Some of the venture capitalists, right, start monitoring from way back, and they just keep updated. They keep up to date with what you're doing. So the first level is just clean your house, have your documents, your governance issues, your financial, your legal, basically all these things that they do due diligence on. Have them almost ready, because again, when you start these commercial conversations, again, remember the investor community is very tiny. So imagine starting a conversation with Tonya and you're completely unprepared, you're completely not there. Probably Tonya will tell Brian the same thing. So by the time you're getting to Brian, they already know, like, that's the Morris who's not prepared. So this may be a time waste for my coffee. So I think as much as you can try to prepare your stuff before you even start talking to even one of them, then when you start talking to one of them, do not go in with an expectation. Just have multiple meetings with them and get as much feedback as possible and see what to implement. Then now start going after the ones that you think these are aligned to what my business is. Because again, the one thing that I've been told, and I've also experienced as somebody who gets sometimes cold emails, is when somebody is not aligned with your investment thesis, as somebody had mentioned it on the call, and they're asking for funding. For example, Andreata is purely a commercial investor, and when maybe you're asking for grant funding from her, So already it shows them that you've not even done the work to know who they are. So why would they do the work to talk to you? So it's almost like that's the last level of like, I'll do my due diligence on them. So as you prepare for them to do due diligence on you, you also do due diligence on them to get to know them better. Because sometimes, yes, it's not about the money. You might bring in investors who are maybe not good people. So you want to know them a bit deeper in terms of talking to their portfolio companies, getting to know what they like hearing before you even approach them. And what I've also seen is powerful is when an investor introduces a startup to another investor. It's very powerful because there's that bit of camaraderie and trust that they already have within that community. So just having those conversations with them, building a relationship, then them referring you. They might not invest in you. They might introduce you to another person who will invest in you. That is also very powerful. And as you're doing all this, again, it's a very tough journey for founders, and I empathize because as you're doing all this, you're also out there talking about your business, so that on public forums like Meta or networking events or online webinars and all, because the first bit of due diligence that they usually do, that's what I've seen, especially with investors who are investing out of the continent. They come to the collective, the spaces like Meta, iHub, and all this way to ask, hey, do you know of this startup by Brian? Then probably you'll be like, I don't know it. And for them, that's already a red flag. Like, if this company is not known, so probably they don't have traction. Or so you find it's very important to these co-working spaces, incubators, and all. That's the value that they usually bring, especially when you have investors who are coming in from abroad, coming in to look at, because they don't have time. They have like maximum a week, and they want to meet as many people as possible and keep track of them. So they go to a place where they know this is where I'll find a lot of information about startups, let's say in healthcare or insurance. And the people that I get from here are already trusted by this entity or this person, so I can keep on looking at them. So that's another strategy that I've seen people do.
I like that too. Okay, so on to Brian's question. Are in-person networking events starting to pick up again? What to do in the absence of those?
Yes, they have started to pick up in a hybrid model where you find spaces like where I'm sitting has 60, 70 people capacity, but then we do like half the capacity and then streamline virtually. You're seeing even the government itself has started doing in-person events on a hybrid perspective. I do think in the absence of them, I've seen a lot of founders organize themselves. There used to be very good catch-up with founders run by a startup called OkHi, which is I think a geolocating or geo-mapping startup. So it's just more of like, if you're not invited on the table, create your own table type, where you coalesce as a couple of founders and you just have various discussions, and before you know it, one founder invites an investor invites, and then you become a community of people. Especially now with virtual capabilities, I think that is very possible. Anybody can organize. There's no monopoly of organizing right now, but I think that's what I've seen most people do right now, especially in the absence of physical events.
Okay, fantastic. Are there any other questions for Morris before I wrap up with my last question for him? And you can put up your hand, unmute your line and speak, or type into the window. I'll just give it about 30 seconds while that happens. You have a comment, Morris?
Yeah, I would like to just speak to a couple of examples that I've seen people do, and this is what I'll quote as affordable storytelling. I've seen a lot of people once building a mailing list and keeping them updated, for example, of founders that you meet over time, and just keeping them updated with no asks. That's one affordable way you could do. I've seen a couple of companies like Enda, Mshule, Soccer Watch themselves do a lot of that also. And usually it's almost like an email or a newsletter coming from the founder on what they're thinking. I've also seen a lot of people utilize platforms like LinkedIn because also they're a bit democratized in terms of who gets to see your update. And just telling the story of this is the progress that we've had as a company over time and why I'm proud of it, and highlighting the team. And simple things like that gets the right audience sometimes. So that's also an affordable way that I've seen most people utilize it. then, of course, yeah, apart from also panels. So I just wanted to highlight a couple of affordable ways of how startups could use the existing tools for storytelling to different audience.
I think these two ideas are so phenomenal, and actually the former more than the latter around, if you could curate a great list of and it doesn't matter, right? I mean, like you said, no strings attached, but people who have potential interests in the stuff you're doing and could actually be part of your network and connect us to other funders or whatever that looks like. That newsletter piece, I think, is really phenomenal. I think it's a great idea, super targeted, and makes sense. I'm curious about the LinkedIn example, though. I was having a conversation with a friend the other day, and does it feel lately, and I'm a fan of LinkedIn and Reid Hoffman and all of that, but does it feel like it's over? It looks like everyone's really killing it, and so it doesn't lend itself to good. Like if I was going to do a newsletter type thing, it doesn't lend itself to vulnerability and speaking honestly to this is what we've been battling with. We're still struggling to gain the right traction here. It's not the kind of place you can have that conversation because everybody else looks like they're killing it, and now here you are with your not killing it narrative, right? What's your take on how to then approach that kind of engagement? And Brian, thank you for supporting me on that.
Yeah, agreed. LinkedIn is a place where everybody is at the top of Rockefeller in the US. Everybody's doing well. I do think, personally, I don't follow anyone who I don't know. So my community within that space is very insular and people that are targeted. But the other thing that I've noticed is that as well as there's a lot of posers who pose to be this and they're not really, there's still some genuine people, to be honest, on LinkedIn. And if not the right, because again, some people that you might not get their contacts, but if you're following the right people, of course, the right people like it and the algorithms will do it, and the other people who are right will also look at it. So as any other platform, I think there's a challenge with it. But so far, for me, what I've seen right now, it's the best platform compared to any other. Social media is good, but then it'll get you more eyeballs to get awareness, but to getting you the right kind of people, still LinkedIn, it's still there. I think it's still powerful in terms of just getting the right eyeballs to see. Because again, it depends with who do you want to see, who's your audience, and what information are you putting out there for this particular audience. I know that Peng Chen, the founder of Hustle Sasa, I think, on LinkedIn, has a very good sort of like work commentary on what he's doing. Same to even Peter Jones of Twiga and Grant Brooks of Twiga. They do use it a lot to showcase like some of the work. And you could see the richness of the platform with the people who are commenting, let's say, when they do something good. So I think it's just a matter of consistency and the people that you follow or follow you that might influence that. I still do think it's a powerful tool, to be honest.
Yeah. No, and I agree. I just was curious to know your sentiment on that. I think the takeaway here is how you started it off around really target your community and the people around you in that forum, and then that helps you get the best out of it. And I agree with you. It still is potentially the best in terms of engagement and accessibility to the right people.
Yeah.
So I'm gonna, I don't know if there's any more questions from the audience, and if there is, please type it in or put up your hand. But I want to wrap up with you, Maurice, the way I started with Andriata and while you were having technical issues. And for me was very, and I'm an optimist. I'm an eternal optimist, and mostly I'm an optimist about Africa, and I believe so are you. And it feels like things, for me, it's a wonderful time, right? Even just some of the commentary we're seeing in the chat here around big rounds of fundraising, $200 million by Wave and so on and so forth. It's like there's something abuzz. Africa is more connected than ever. I think some of the regulation, and we all hate regulation, but I think that there's definitely some pro-innovator regulation happening now, like the Africa Continental Free Trade Agreement that opens up markets and connects everybody. And there's no better time. And then, of course, the world is flush with cash, as Andriata told us. So, it feels like it's a great time for us. For you, on a personal, professional, as part of Baraza Media Lab, what's exciting you right now? And if you can just help us finish up on that note, that would be excellent.
Yeah, I think the continent is on a high right now. Even despite the COVID challenges, you see big rounds, yes. You see, how do I say? You see things like after good policies and all. Um, for us at Baraza, we believe on the power of storytelling, first of all, either entrepreneurship, governance, or anything. And fortunately, right now, there's on the entrepreneurship side, we are thriving as a continent where there's always good news popping here and there. Yoko from South Africa raising, Twiga raising, all these companies are raising good funds, which means it's employment eventually. But as we are all doing this, there's also a bigger call from the entrepreneurs. And I know entrepreneurs are not to solve all the problems of this world, right? But I think as we are, as a continent, are grappling and struggling with our governance and leadership, with Tigray and elections in Uganda and Tanzania, at least there's some good hope and good stories that I see through entrepreneurship, which are coming through of people solving the dire situations that we are facing and companies working tirelessly to be able to better our systems. So for me, it's just hope and encouragement to the group that is here that you are building infrastructure. You're building it from ground up, where our existing structures have failed us. But you are building it, so you're the little brave ones who are around us. And that's the stories that I would like to portray as we go into other good things like AFTA and other people raising.
Yeah, fantastic. I see a hand up, and Wema, I'm going to give you the opportunity to speak. Please go ahead.
Thank you. So recently we're having a conversation around VC with some other entrepreneurs, and well, there's a narrative about VCs helping us, which we really appreciate, and we're happy that people are raising funds. But there's also the other narrative where there are some entrepreneurs who are very skeptical about VCs because there are some untold stories that go by where the people are kicked out of their farms and some malicious investors. Malicious is a strong word, but yeah. So, what would you say about this, or what measures do you think we can take as founders who maybe don't have, yeah, founders who, well, you've already told us to get lawyers and all of that, but things happen. So, what do you think we can do to better place ourselves as founders? And what's your opinion on all of that in the African landscape?
So I'll say that I'll start with this sort of like not a disclaimer, but my opinion. Not every company is venture capital investable. Not all companies should go for venture capital money, because venture capital money also comes in with its own restrictions and conditions, right? And again, fund managers also have a duty to the investors to return a big return. So it's not most guys here. Very few have their money in the VC. Mostly, I'm a fund manager. People that we call VCs are fund managers managing somebody else's money or other organizations' money that they have promised also that we are bringing you 10 to 20x returns. And that means for you as an entrepreneur, you have to help me as, let's say, Maurice as the VC to give good returns to this person who has given me money. So I will try as much as possible that your systems, your governance, and everything is right so that I can get that money and return it. So if you look at it from that lens, you figure out that you as an entrepreneur still have power to some extent in terms of controlling the outcome, because this person, as Maurice, who's the VC, is an intermediary between you and the people who own the money. I think if you understand that power dynamics in terms of this agent, the VC, requires good returns for me to be able to for them to be able to raise and invest more, then you can be able to be a bit empathetic to them. But what I'll suggest is doing a bit of due diligence, because the VCs do a due diligence on you, right? They check if you're the right person, if your business is the right one, if the total addressable market is right. Why wouldn't you also spend a little bit of time, as well as, yes, there's that rush or that anxiety or let's say desperation to get these funds? why wouldn't you also do a little bit of due diligence on them in terms of talking to their previous? That will not cost you anything, talking to their previous portfolio or their current portfolio. Talking to other investors and just getting to know, like, how does TLCom invest? What are they known for? What do you think, And more than often, you find that maybe it's not a good relationship. So I've had people use this analogy a lot, that it's a marriage where between two people, the VC and the startup. So you also have to do due diligence. Don't be shy to do due diligence on them. I don't know if I've answered your question, Wema, in terms of what are the most easy ways to do it instead of hiring a lawyer. The legal part actually comes in only on the documentation. But again, there's usually a lot of gray areas in these papers, right? But if you're dealing with a person, then that's different. Get to know them more, and that will give you a perspective if they're good people to work with or not. And you could do that through talking to various people within the community. And you'll hear those stories. You'll hear those untold stories, and you'll just run away. Even though the deal is so sweet, you might just run away because you've heard a story of this person and you don't like it. And more than often, sometimes you find like a case of one of my good friend Fares Karaoke from way back. Not to paraphrase what he said, but he basically said, hey, listen, I was young back then. I didn't know what I needed to do to be able to protect myself. And it's my fault as a founder. And he owned up for him getting kicked out of his company, but the way he was done is what he didn't like, which I agree with him. So sometimes it's some things that you don't know. So also talking to other founders who have gone through this process is easier, but also protects you a lot, because you don't want to be a use case or another case of this happened. And just having your documentation right. We've seen not only even founders, we've seen co-founders kicking each other out when money comes in. So those co-founder agreements to things like the shareholdership of the organization. We've seen a lot of people. Actually, that is more prevalent than actually founders kicking out founders. It's more of co-founders and founders kicking each other out or taking over the business. So that is a lot, actually.
Yeah. I think that's very well put. And I think ultimately, obviously it's not just a local issue. Even at Uber, it happened, and we've seen that happen around the world. But ultimately, and maybe I'm a purist in this sense, and I have a legal background. Your future and the future of your company are not inextricably linked. You're not the same entity also, right? So it's as important as a founder to take care of yourself as it is to take care of your company. But your company will have the benefit of a board, right? And the board will look out for what they deem at that time is the best interest of the company. So I think that there's always, in most cases, like Maurice has said, it maps out and the interests are super aligned. But in a few cases, and I remember Fares' case being such a big deal back then. I mean, it was like all of us were up in arms and ready to go start picketing. And I love the way he came through that. So I think there are lessons to be learned there, but I think it's important to take care of yourself as well and to do your own due diligence. And that's really the takeaway. Yeah. Good. All right. I think with that, we probably have come to a close on our session today. So we had Andriata kick us off earlier on today. You know what? This was such a learning experience for me as well, from both you, Maurice, and from Andriata. I have a page full of notes. I don't even know. I was going to go through this process of say, what are the top 3 things I learned today, and just use that to summarize. But I've got something like 14 points here, so I'm not even sure what's more important than the other. But there are a couple of things that I really liked. I liked the concept of affordable storytelling, and how do you start to use that then to start creating and curating your network of potential investors. And I think that there were some really great nuggets there that are things that you can actually activate and do today. And and it could be something that, you know, your first list may be 3 people, and then, you know, they'll bring a friend, and then it grows to 5 and it grows to 7. But it's really very well handpicked to get the right people around you and knowing and hearing about your company. I connect that with the points that you brought on, you know, using the meta example, getting yourself on stage, you know, where do you tell your story, and where do you take the opportunity to tell your story? And a lot of forums, it's such an important point, but, you know, some of these co-working spaces look like they're just co-working spaces, but they tend to be where the collective is and where people come to first. So, you know, where and how do you connect? Whose events list are you on, and how do you ensure that you're keeping abreast of some of that stuff that's going on? I loved the piece around starting with why and really crafting your story around that. And I know for everybody on this call, we're gearing up towards demo day, so that's a super important element. And why then leads into the what and how and so on. But really the start with why that touches the core and anchors really your business where it stands. I like pieces around due diligence, because oftentimes you feel like you're the little guy because this is the big guy with the money, but it's your business, and you're probably more invested because it's your heart, blood, sweat, and tears, right? And so you owe it to yourself to do that right due diligence. And honestly, sometimes maybe you're a little bit desperate, but you know, sometimes to say no, because that's not the type of investor or person you want to be married to for 7 years, right? So I like some of those pieces, and I think that they're real nuggets to take home. From Andriata, I think it was, you know, some pieces that we all know, but I think there were a couple of pieces there. What really resonated with me the most, and I think hopefully with everybody, was just that piece around the rejection and that when an investor says no, it's not that your company is not a great company or your idea is not a great idea. It's just that you're not a fit for them, right? And it doesn't mean that your business is not a good one. And it's kind of buckle up and let's go to the next level. But I really like that because, I mean, this rejection, it can take its toll on you. And sometimes you wonder what you're not doing well. And then on LinkedIn, everyone seems to be getting new investments. So I think I want to wrap up with just saying thank you so much, Maurice, for joining us today. I think it was a wonderful conversation. I think everybody here, I'm sorry, I'm training a puppy and now she's barking, so please forgive me for the background noise. But I want to say it's been such a pleasure. And your tips and tricks were really well received. And we look forward to being able to engage with you again in the future. So thank you very much for taking the time for us today.
Thank you. Thank you so much. And I'm glad to be here. I think it's time for me now to return this laptop that I commandeered. And sorry for the
Give
lateness.
Dan back his identity. Yeah. All right.
Bye,
and
guys.
thank you, everybody else. Have a great evening and a great rest of the day. Bye-bye.
Bye.
Goodbye.